Welcome to day 4 of the E2 Beginners Trading Bootcamp, and in today's episode, I'm going to be teaching you guys market conditions. All right, so market conditions, there's two conditions usually for market conditions. Not going to go into the advanced version, we're going to the simplified version too for you guys beginners out there. You're either going to have a trending market or a consolidating market or ranging market. These are the two types of market conditions you will face. Price being bullish or bearish, you can also consider that market conditions. I consider that more so a trend. I'm mainly focused on if price is trending or consolidating, meaning ranging. So trending is something like this, where direction is very clear, one-sided, if you want to think of it like that. Consolidating markets means price is choppy and it's just moving sideways. If you want an easier way of understanding consolidation or ranging markets, it's when price is barcoding. So think of it like a barcode. Prices goes between all the lines, black and white, black and white, black and white. It's like a barcode. All right, that is ranging markets. These are two conditions. Now, which one is bad? Which one is good? There's good conditions and bad conditions. In trading, as a trader, you always want to trade during good conditions and you want to avoid trading during bad conditions. If you had to take a guess, which one of these conditions do you think is good? Which one do you think is bad? Give you guys a minute here. All right. As you may know, trending markets is what you want to be focused on trading and taking advantage of, because trend is very clear. As long as you're following the trend, you can easily have above a 50% win rate. Now, in a consolidating market, not so much. Why? Because direction is not clear. You will get chopped up. And remember when I talked about liquidity sweeps? Well, guess what? In a consolidating market, you will get tons of liquidity sweeps. Price is going to sweep the highs and lows. And these are not even breaks of structures either, because these are going to be sweeps that occur randomly in the market. Why does the market do this? I'll give you a brief reason to why in one sentence. It's just to generate liquidity. It's to stop you all on both sides. Another thing is consolidation theory. When price consolidates for a certain amount of time, right, for a long time, price is going to break out at some point to either the upside. So let's say we have a trend here, a market consolidation here. Price is either going to break out to the upside or break out to the downside. It's going to typically end in a pretty big move that you can expect within the market itself. So like for example, here's a perfect example of consolidation. This is a ranging market. You don't want to be trading when we're ranging like this. You can see price does sweeps at random. We took out this high here. We took out this low here. And look, we took out this low once again here. Even though there's no reason to sweep twice, but we did. So here's just a perfect example of, understanding really to stay out of consolidating markets. Now, if you're already in a trade, you can't do much about consolidation. Because let's say you took your entry here with one of my models. You guys are in a course, you know exactly what model this is, but let's say you took this L model here. There's nothing you can do. If you entered, when you entered at this time in the market, you can see price is very clear. It's a very clear range. We're not consolidating. It's one-sided. You're taking this internal reversal, but you can see it was fine originally, and then now once it starts consolidating for like 2-ish hours, you can't do much in this situation. Usually, this is when back testing comes into play. Find out what you like best. Also, based on your personal preference in terms of personality. Do you like holding trades for long or do you not? If you don't like holding trades for long, go break even on when price consolidates, or matter of fact, just manually TP and just wait till price clears up. When I say clear up, usually when price consolidates, it's going to be within like a box, something like this. So you want to wait to see body closures. This is why you guys have to understand what bodies are in the candles. You want to wait for a few body closures above or below the range. When we have a new range essentially being built, that's when you can look for more trades. So for example, here in this case, you could look for more trades here, maybe even to the downside, like that example where I talk about internal structure came into play. Because we have a new range, we're not consolidating anymore. This is good, this is fine. But again, try to avoid consolidation as much as you can. This is bad price action. Here is an example of good price action. Good price action because one-sided. Good price action, one-sided delivery, right? Again, we're trading, or at least me, I'm taking and focused on more internal reversals. So when I see we develop a one-side range like this, I love taking this reversal because I know it's going to be clean for the most part. But when we do consolidating or do consolidation, it looks trash. Like something like this looks trash, right? Nothing much you can do. We just had a random sweep out of nowhere here. Here's another example of consolidation from earlier today. Literally on stream, actually, when I was streaming, we had massive consolidation. This is very bad. Now, if you took the initial entry called out on stream, you're fine because, you already took the entry here. You have the ideal entry essentially in consolidation. You can see it, you see how it took out this high randomly out of nowhere for no specific reason. Yeah, that's consolidation. That's what you can expect when you have bad price action. Avoid consolidation, trade when we have a clear range. Like, look, we had a clear range here, but that doesn't mean we can't later form consolidation. So if you didn't take this initial long here or short here, if you want to take longs, you take longs here. It's a nice scalp. If you didn't take shorts here, well, guess what? Ideally, you don't take anything here unless you wait for a sweep. So otherwise, you're going to get chopped up in the middle of the range, trading range here, right? You're just going to hit your stop loss, and you can see price goes in your direction. Good price action, good price action, good price action. And when I say good price action, you can also call it, good delivery. It's roughly the same meaning. Good, amazing price action, amazing price action. And you can see sometimes we will consolidate, but for the most part, stay away from consolidation unless you're already in a trade and trade the trending markets. I'll give another time frame example. If we go to the higher time frame, trend is going to look a lot more clear, like I mentioned. Like in this case, obviously this is hindsight, but we're going down, right? Because, well, look at this. If we go to the 1 hour, you see that we have looked to the right. Stop looking to the left too much here unless it's an important POI. You can see we've already been going down. So what can you expect on lower time frame? We create more structure to the downside, and AKA that means we're trading in a trending market. On a 1 hour, we're trading a trending market, not consolidation. Very clear downside, right? You can mark out your structure. Very clear downsides. We're creating break structures to the downside. We're maintaining highs. Now, if we are chopping, then of course you don't want to trade. For me, most of the times, it's going to be either 1 minute chop that I avoid, or if I see on the higher time frame we're chopping. So let me see if I can find an example. Don't really see too much here. You can kind of argue like right now we're kind of consolidating here in a box, but this isn't as bad as some other stuff I've seen in the past. So no two specific examples here that I can clearly see on my chart. At least high time frame for indices, we tend to trend very well instead of consolidate too much because indices tend to go higher over time and create new all-time highs. So I hope you guys do enjoy today's video, man. Just talking about market conditions. Trending markets is when you want to take advantage of trades. Consolidating markets, or when markets are ranging, is you want to kind of avoid taking trades. And if you are taking a trade, wait for a liquidity sweep. So the range higher low is getting taken. So wait for those sweeps, and that will improve and help with your win rate trading. Hope you guys enjoyed today's video. I'll see you guys in episode 4 or episode 5 of the bootcamp.